We're not stock jocks. We're not day traders. Obviously, we pay attention to the stock market. I talk about it a lot. Over the long term, stocks, via the power of compound interest, remain one of the best ways to grow your money and beat inflation. But investing in the stock market is not all we do. Far from it. We have plenty of clients that hold fixed income positions like Treasury bonds, corporate bonds, and CDs, certificates of deposit. We are holistic wealth managers, which means we manage money in an assortment of investment vehicles outside of the stock market too. We are here to manage the wealth of our clients and their families, not simply to manage stocks. And now, one of the most important things that comes up in the wealth management business is the fact that you can earn money on short-term, low-risk investments. Finally, look at this chart. Much has changed the past few years as the feds have finally started to raise interest rates. You wouldn't always know this just checking your savings account. Your savings account at your local bank still probably hardly yields anything. But if you go out about 3 months with an investment backed by the US government via a Treasury bill or even something like a money market, you can earn about 5% APY. That's many times over what savings accounts rates are paying. So some of us may still be stuck in the past. You may have money sitting in a savings account at a bank still earning pretty much nothing. That can be a good thing when it comes to emergency funds and needs for liquidity, but it can also be a touch on the silly side nowadays. Does it make sense to be sitting on tens of thousands or hundreds of thousands of dollars doing nothing? Maybe. But maybe not. And the issue, if you're doing that, is not that you're a terrible investor or something. The issue is that you may just not know your options. So what are these things called Treasury bills? What are these things called money markets? Treasury bills are kind of like a CD in that it is backed by the full faith and credit of the US government. What's the FDIC? A federally insured deposit. What about a money market? Money markets often have Treasury bills and things of that nature within them. But in a money market, it is entirely liquid. The difference between something like a CD and a Treasury bill over against a money market is that money markets are liquid. And oftentimes, many money market funds are currently yielding about as much as what a Treasury bill or even sometimes a certificate of deposit is yielding. So again, the issue is going to be do you want to lock up money or not? Do you need money quickly or not? Or do you just want to kind of play it safe for a while and maybe take some off the sideline from stocks or whatever else it may be and utilize some of the high yields that we have now that we didn't have for a very long time in our low interest rate environment? But do you really need to be sitting with a bunch of money in a savings account earning hardly anything? You probably already have banks reaching out to you. Maybe a phone call at your local bank, maybe through emails or marketing. But here's the thing about a bank is oftentimes if they put you in a certificate of deposit, you lock up your money for a set time. And then whenever the monies come due, then you have access to them again, or you might face some penalties. The issue may be though, in the future, currently, that can change, but currently the feds are indicating that rates will go lower. So what happens if your money is locked up for a year, 2 years, whatever it might be, and then when it comes due, you have lower rates? This is where something like a wealth manager can come in who can help you ladder portfolios, have different maturities, or maybe none at all if a money market makes sense, and to give you some other opportunities. Here's something about banks that I find really frustrating as somebody who gives financial advice for a living, is that sometimes when a CD comes due, the money matures in the account, and then they might send out a letter. You might have 15 days, 20 days, 30 days, whatever it might be, to respond. Otherwise, they will take that money and then relock it up again for a particular term. Now, the reason why that drives me crazy is because I personally think you should communicate with clients. As a wealth manager, if somebody's money come due, I'm going to reach out to them and talk to them about it and not just assume that if they miss the mail or they have a lot of different things going on in their lives, I'm just not going to take and lock up their money again. But sometimes the way banks like to keep money is to engage in that practice. So if your bank does that, you just might want to just double check on those CDs that you might have recently locked in. What happens when it comes mature? Does it just go back into a cash money market or a savings account, or do they automatically turn around and then reinvest it again, even if they don't talk to you? One of the benefits of having a trusted financial advisor and trusted wealth manager is that you can pay somebody else to watch out for that stuff for you. Most of all, here's what I want to do. Like on this YouTube channel, we're after financial education. I want to educate you so that you understand, hey, if you got a bunch of money that's just sitting in a savings account, you probably got some other options. Quit living in the past. Hey, if you like our content and you've enjoyed our channel, watch a bunch of the other videos. Send it to a friend, like, subscribe, share our content. We'd appreciate it.